This is so simple, but you need to know how to do it. So I'm going to give you points for knowing something really simple. I apologize for that. I know I didn't know anything. Okay. Anyway, lower cost or market. If you take a look at page 474 to 475, talk about it. You'll see in the summary of significant accounting policies for virtually any company that has inventories that they use lower cost of market because you have to. Okay. And what do we mean? Cost is our historical cost is paid for the inventory. Market is an estimate of its market value.
How much you would have to buy one for it?
And maybe what you would replace it for now, or it's really three different measures, aren't there? Maybe your normal sales price, right? Less. Your cost of disposal, that's another one, right? Or you could take that amount and take what? Well, net realizable value less normal profit margin, which is just sort of a normal cost of goods sold. So we use three different estimates to come up with our lower cost of market, right? We're going to take the one that's in the middle. It's a little arbitrary, right? You just get three estimates and you take the one that's in the middle. Don't average the three, take the one that's in the middle. So when you look at this, they call them ceiling and floor, but it's kind of obvious where they're a ceiling and floor. They are, but it doesn't help you much to know that it's a ceiling and floor, I don't think. But how do you calculate them? What's the deal? How do you calculate ceiling and floor? Let's take a look. Let's do an exercise maybe. Exercise 92, for instance. Okay? We've got estimated selling price. I'm on page 507. Estimated selling price, cost, replacement cost, estimated selling expense, and normal profit. Okay? By the way, if your estimate of market is higher than cost, what are you going to use? Cost. It's lower than cost. What are you going to use? The market. Okay? What I would suggest to you, though, is get your estimate of market first, then compare it to the cost. So separate the cost out. It's this simple. Okay? And we'll put market over here. There are going to be three different types. What are the three? What do we call them? Net realizable value is one. And net realizable value minus normal profit. Okay, which is sort of a normal cost of goods sold. What do you think about it? We don't call it that. And what's the other one? Replacement. And we're going to take the one of those three, net realizable value minus normal profit and replacement cost. We're going to take the one of those three that's in the middle, right? And that's going to be our estimate of market, and then we'll compare it to the cost, okay? And we'll just do it over and over, okay? So let's do it with a couple of these. Take item D, for instance. What do we know about D? Sales price is 120. What do you want to do to get net realizable value? It's the estimated sales price less any direct selling expenses you're going to have when you dispose of it. Less disposal costs, in other words, right? So it'd be 120 less what? 30? It'd be $90. Everybody see what I did? This is just really simple. Okay, I'll have you do one of these on a quiz, probably on a test, probably on a final, I don't know, at least in two of those places. Okay? Then what do we do? Subtract the normal profit. What's the normal profit? $20. Out of that 120, 20 is going to be their normal profit. Got the idea? Okay? So if the normal profit is 20, you'll take 20 away from the 90, and what do we get? 70. That's simple. What's the replacement cost? If you buy it now, it would be 120. Costs have really gone up. What was my original cost on it? 75. Okay, so there's the first one. There's D all the way across. Everybody see it? So what do you do next? Yeah. What's going to be my market value that I'm going to use? The one that's in the middle. 90. And I'm going to compare that to what? Cost of 75. And then I'm going to take the lower of the two. So what value am I going to use for these inventory items? 75. If I have 1,000 of them, I'll take 1,000 times 75. Not kidding. Okay? Everybody got it? Now what I'm doing here is specific item, right? Item by item. You can group them, and we'll talk about that in a few minutes. Okay? Good? Yeah, that's it. That's all you got to do. Okay? Let's try the next one. E. What would you do, guys? Same thing. Estimated selling price is 110. What's the normal profit? What's the normal profit on this one?
20.
Wait a minute. Net realizable value. I did the first one wrong. Did I? 120 less 20.
120 less 30.
Oh, estimated selling is 30. Okay. 110 less 30. I'm sorry.
That's 80.
110 less 30 is how much? 80? I did it right. Trying to do this one wrong. Okay, that one's 80. Then we take away the normal profit. What's the normal profit? 20 again. So what do we get? 60. What's the replacement? 72. Can you see that any of these three could be in the middle? Which one's in the middle this time? 72 is, of course. Okay, so that's the one we'd use. And then what's the cost? 80. And then I'm going to compare 72 to 80. Which one am I going to pick? The lower one, 72. Times the number of units I have, that's it. Okay? Lower of cost to market. I guess they're good estimates. I don't know. I don't know why we don't take the average of the three. I don't know. What was the value? Okay? All right, let's try another one. Try F. What do we get there? Estimated selling price is 95. Selling expense is 30. So what's the net realizable value? 65, is it? Okay. Then less than normal profit. What's the normal profit? 20. So what do we get? 45. What's the replacement cost? 7. Which one's in the middle? Notice I'm not doing cost until I'm done with these and get the one that's in the middle. Notice I separated the cost. That's the most common error people do, is they get them mixed up and they go crazy. Okay? What's cost? What's lower? 65 or 80? Yeah, let's go with this one. Times however many number of units we have. Okay? Everybody got the idea? And we could just keep going and keep going and keep going. Why is, which one's the ceiling and which one's the floor, by the way?
The lowest is
Net realizable value will never go above net realizable value, because if replacement cost is more than net realizable value, it'll be in the middle, right? And net realizable value minus normal profit is the what? The floor. Why? Because it's always lower than net realizable value. So of course it's the floor, right? You can't go below that. If replacement cost is higher than that, we'll take replacement cost. If replacement cost is lower, we'll use that. So don't let ceiling and floor mess you up. They are ceiling and floor, but they're kind of obvious after you see it, right? That's not something to memorize. Just take the one that's in the middle. Okay? So then let's say we're going to do it for the inventory as a whole. So, and we have just these inventory items. We have one of each. Just to give an example of it. We have one of each of these. Could be 1,000, could be 1,000,000, I don't care, whatever many you have. You take the quantity times the cost, right? What would we do if we were going to do the inventory as a whole? Another way you could do it. We could do it by each item. Take each one of these lower cost or market items that we just came up with, the 75 times the quantity, the 72 times the quantity, the 65 times the quantity, right? And add them up. Do it for 100,000 inventory items. Don't you care? Okay? What if we want to do it for the total inventory? What would you do? say that these are the total values of the inventory now for each one of these. But if you want to do it for the total inventory, what would you do? You can get the total of all of them, couldn't you? Right? Stat them up. So if we did that, what would they be? 90 plus 80 plus 65, huh? How much is that? 170, 235, is that what that is? What's this one? 130, 175, right? What's the next one? 190, 262. Then what's the cost? 160, 215, 235. Okay. Then what would I want to do? So this is my total inventory. Imagine you have 100,000 inventory items. Got the idea? Or 1,000 inventory items, doesn't matter. What would you do? What am I going to take for market? 235. Right? What am I going to compare it to? Cost. Well, my example didn't work real well. Okay, so what would you use? 235, obviously. But if cost had been higher than market, you'd use the market, right? Okay. Got the idea? If market is higher than cost, you'd use the cost. So what's going to happen if you do this? What tends to happen to your write down to market? How much, in just our example here, how much are we going to write down? Nothing, right? Because cost is equal to market in this case. But if market happens to be more than cost, you're going to leave it at cost. You're not going to write it down, true? What would happen if we did specific identification here? Which ones would we take? On F, we'd take market, and we'd write it down from 80 to 65, wouldn't we? So each item we would write down by 15 bucks, okay? What would happen on E? We'd write it down from 80 to 72. Each item we'd write down by 8 bucks. What would happen on D? We'd leave it at cost. What do we end up with? More write down. So if you do specific items, you're more apt to get more write down. If you spread it across the whole inventory, average them out, in other words, right? What happens? You tend to have a smaller write down if you have one at all. Make sense? You can also do it by inventory categories. Let's say we have 100,000 inventory items, and they're by product groups. We have 10 product groups. We could do each individual product group exactly the same thing. Get market, get cost, and either write it down or not, right? And then add up all the inventory, all the 10 different product types, add them all up and get the total inventory. What's going to happen there? They'll be offsetting where it's lower than market, or where market is lower than cost, right? They'll be offsetting some of them, right? But not all of them. So how would you think this would work in terms of your write-downs? This is kind of a common question. What would happen in terms of your write-downs if you do it for each item for total inventory and for by category? So you've broken your inventory into categories. They talk about that. What do you think, guys, by categories? What do you think? Which one is going to tend to give you a larger write-down? Which one's going to be the largest write-down? If you have one. Of course, you could not have one at all. If cost is always higher than, or I'm sorry, cost is always lower than market. Which one is going to give you the biggest write-down? Item, biggest. Which is going to give you the smallest? Total. Tend to do that, right? And then which one's going to be in between? By categories. That's a fairly common question. And these are easy ones, right? Everybody good with lower of cost or market? How do you record the lower of cost or market, by the way? What would your journal entry be? That's not bad either.
Then use credit, inventory, and debit cost of goods sold. Well, there's two different ways, I think.
Yeah, there's a little bit of variety on this, isn't there? You want to credit inventory, it's a write-down, right? You could credit inventory for whatever it is, merchandise inventory, and debit cost of goods sold.
but then that figures in cost of goods sold, so the other way was to debit a loss on write down of inventory.
Or
Due to decline of inventory in the market.
loss due to decline.
And credit.
To market value, right? And credit inventory. Okay. There's more. This is, I want to classify it separately. This I just buried in my cost of goods sold. It's fine. Either way. Okay. Now what? What else might you do? You talk about an allowance. What would that be?
Due to decline. That's what it's not.
Yeah. You'd have this loss here. Let me go. We have the loss due to decline. To market value, right? Decline in market value. And credit allowance for what? To reduce to market value. Yeah. And what kind of account is that thing? Contra asset. You take inventory, which you leave at cost, and you show how much it declined in value. Huh? You like that? You can either keep it in a separate account and not show it on the face of the balance sheet, or you could show it on the balance sheet, right? Or you can show it parenthetically on the balance sheet. I don't care. Okay? Variety of ways. Could you do this? Could you debit cost of goods sold and credit the allowance account? Yes. So it's sort of mixed match, huh? Okay? Everybody got it? Not a big deal, huh? And then what would you have to, by the way, is that allowance is a balance sheet account, huh? The loss is an income statement account. What do you do with all the income statement accounts? Close them to retained earnings, they're gone. What do you do with the allowance account? Nothing, you leave it there. So what are you going to have to do at the end of each year? Adjust the allowance from where it is to where you want it to be for the next year. Right? If you sell off the goods, the allowance might go down. Right? Make sense? By the way, what if the loss is recovered for future periods? Can you write the inventory back up after you write it down? Can you write it back up? No. Don't write it back up. What if you're in a country that uses international financial reporting standards? Yes. You can write it back up. But their deal is you can't sell it anymore, right? Okay. So anyway. Why do we do this, by the way? Why do we write it down?
To better reflect how much it's worth.
To better reflect how much it's worth? Yeah. But why don't we just use market then? Why don't we write it up to market? We want to be careful not to tell people inventory is worth more than it's worth. That's true of all of our assets, right? You write your accounts receivable down by increasing the allowance without for accounts, don't you? You guys agree with that?
Conservatism is it?
Conservatism. That's right. It's conservatism. We want to be real careful not to tell people the inventory is worth more, right, than it costs us, right? Or more than it's worth if the market is lower than it costs us. So we wouldn't want to write it up because we're conservative. Otherwise, what could you do? I used to have a client that was a jeweler. And they made this horrendous mistake. They got real excited. They just started the business and they bought a whole bunch of gold. Far more than they could use. But they were all excited. I'm not kidding. Guys bought all kinds of gold. And he had this gold in the safe at the jewelry store, one store at that time. It made beautiful stuff, really nice, and sales were going good. But he had a whole bunch of gold. And then the price of gold went down. He's holding gold. So what do we have to do?
Write it down.
Write it down. It's a horrendous loss. It's hilarious though. He's real upset because he wasn't going to get rid of the gold anyway, but he had to show a loss on his income statement. And he did. But guess what happened next year?
Put back up.
The price of gold skyrocketed. Right? And he made a fortune. He sold the gold, by the way, when it skyrocketed to other jewelers and got out from under the gold. He had several years supply, right? Sold it and made a killing off of it, which of course was what? A non-operating gain, huh? He really didn't like the accounting on this thing at all. It didn't really matter much. It was his business. It was just mostly ego. So he made a fortune off of it He made a lot of money. Got his company so stable. Awesome. Speculating in gold, I guess. Yeah, anyway, so that's how you handle this thing. Not a very big deal, really, I don't think. They go on and on about it, but that's pretty much it. Okay, let's see. Oh, by the way, in terms of the notes, where do you put the disclosure of what method you're using? FIFO, LIFO, average, and lower cost of market.
Parenthetically or in the notes.
You do it parenthetically or in the notes, that's right, in parentheses right next to the inventory account and the balance sheet. Or in the notes, which note typically does that go in? The information, not numerical information, the description of what method you're using. Where does that go? More qualitative and quantitative information. Which note? The first note. Summary of significant accounting policies, either numbered note 1 or not numbered at all, right? Maybe the second note is numbered note 1, depends on how they do their statements. And that first note is where we describe all the policies that we adopted where you have choices. Everybody has a choice between FIFO, LIFO, right? Okay? So you tell people. Same thing with depreciation information. Where would you put the numerical information? Either on the face of the statement or in another note. So you'll have two notes, basically. Part of the summary of significant accounting policies will talk about inventory, right? And then it'll also be in another note, probably. Okay? So where the numbers go. All right. So Mitch talks about it. I show you some examples. Page 474, there's a summary of accounting, significant accounting policies, right? So, all right. Anyway, great stuff. Let's talk about over on page 41. Valuation net realizable value. This one's a little different. I wrote on here in big red letters, exception, valuation bases. Valuation at net realizable value. For the most part, companies record inventory at cost or at lower cost or market. However, many believe that for purposes of applying the lower cost or market rule, companies should define market as net realizable value, selling price less estimated cost to complete and sell, rather than as replacement cost. Based on the fact that the amount the company will collect from this inventory in the future is the net realizable value. Under limited circumstances, support exists for recording inventory at net realizable value, even if the amount is above cost. What would we do? We would write the inventory up or down, right? To net realizable value, which is a type of market value, right? It permits the exception when. You need to know this on page 482 at the top. When do you have this exception to the normal valuation?
When there's a controlled market, that's where we'll applicable to all quantities.
Yeah. So there's a price. There's a market. There's a price in the market. You're going to get that price, right? Got it? When no significant costs or disposal are involved, too, right? So in other words, I'm going to get this market price. If there are significant costs of disposal involved, you should reduce the net realizable value by that. Make sense? Okay. Who are the examples they give us?
Mining companies.
Mining. Yeah. So you're taking stuff out of the ground, huh? Okay. Selling prices are in a controlled market without significant costs of disposal. Okay. Got it? Third reason for allowing valuation at net realizable value is that sometimes it is too difficult to obtain the cost figures. So they talk about minerals and they talk about agricultural products. Okay? So I've had situations when I was out in Washington State, lots of orchards and apples, cherries, and so on. Anyway, the apple crop would still be on the tree. The crop came in really late. They make their year end shortly after the normal end of the crop year. And what would you expect to have happen? You'd harvest all the fruit, you'd know what your costs were, and you'd know what your revenues were. The fruit's still hanging on the tree at the year end. You have to do financial statements. What would they do? You have to value the crop. It's still hanging on idea? We not only we could record the cost of goods sold equal to the market, right? Less selling costs. And you'd record the sale too that hadn't happened. Not kidding. So there are some really strange exceptions for agriculture. Because otherwise, for that crop you would have no sales. You would have no cost of goods sold. You'd only have operating expenses. And then the next year you'd have 2 crops of sales and 2 crops of cost of goods sold. Follow? Right? So we do this for valuing inventory. We even do it for valuing cost of goods sold and the sales, right? Ultimate sales price is going to be in what our ultimate cost is. Okay? So there are lots and lots of exceptions. This is kind of a cool one. Okay? So anyway, you need to know that. Relative sales values. How about that? What are they doing here on page 482? This chapter has a wide variety. Some easy, some hard. Doing easy ones today. What about relative sales value? I make a lump sum purchase. You might do this when you're buying a business, by the way. When one business buys another and they get all their assets and all their liabilities, you know how much you paid for their stock when you bought all the stock? What do you have to do? Allocate that cost to what? All the assets you bought. But you don't know what each one of the assets is worth. You have to come up with some sort of a systematic, rational method for allocating the cost across all the assets. Does that make sense? Well, what if I do a basket purchase of building equipment, land, but I don't know how much each one costs? You might do appraisals on them, but your appraisal might not be the same as the total cost when you add up the appraisals. It might be more or less than the total cost. Got the idea? You still have to do some sort of an allocation. This is a specific example with inventory. We do this stuff all the time, right? I bought a whole bunch of stuff and I have to assign the cost to it. That's all. Okay? So what do they have here? They're buying some land. In this example on page 482 at the bottom and 483 at the top. They bought land, huh? And they got a whole bunch of lots. There's going to be a certain number of lots, and there's a sales price per lot, and then they allocate the cost across the sales prices. What kind of a situation might you do this with? Land developers do this all the time. When I worked for the land developer in Bellevue, Washington, near Seattle, that's how we do it. Buy a piece of land. Some of the land is at the top of the hill, has a nice view. Some of the land, if it was in Kentucky, is going to be flooded by the river every year, down at the bottom. What do you bet the stuff that's up at the top that has a really nice view of the river is worth a hell of a lot more than the stuff down in the riverbank in Kentucky? By the way, on the West Coast, the reverse would be true. The closer you are to the water, if you can see it, the more valuable it is, right? Not around here, huh? Thank you, you flood. Okay? So, their rivers don't flood like ours do. Okay? Or it's often, at least. Anyway, and the banks tend to be high.
Okay, so it might be good if they were like farming and needed the water, like.
Well, for farming, it might be more valuable down by the water. Absolutely. Yeah, good point. Yeah. So, would we value these lots differently based on what they are?
Yeah.
Believe it or not, when you're in a neighborhood, the lots that are on the corners are worth a lot more money than the ones that are not on the corner. Why? Because you have more lawn to take care of? Not knowing anything. But anyway, I like a little tiny lot. Personal preference. But anyway, I wouldn't want to live on the corner unless you have traffic on both sides here. But that's worth far more. Okay? So, might you have really valuable lots and really crummy lots? Yeah, and so that's the example here. Look what they're selling them for. If you want, you could add 3 zeros to each of these, and they might be more realistic than I'm kidding. But that's really cheap lots, aren't they? The sales price per lot for the A lots is $10,000. Maybe we should add 1 zero at least. For the B lots, $6,000. For the C lots, $4,500. It's just what you're going to sell it for. And how many lots we're going to get out of the development in each case. Got the idea? We got 400 lots total. What they did was they computed the total sales price, and they are going to allocate the cost based on the sales price. Make sense? This is really simple. 100% of my sales price is $2,000,005 in this example. Everybody see it? All they did was they took the sales price times the number of the lots. The relative sales price, of course, it's $1 million on lot A's, divided by $2,000,005, and you get, what percent was that anyway? 40%? And then whatever percent lot B is, and whatever percent lot C is of the total, and then so then that percent they're taking times the total cost, and they get the cost allocated to the lots. Simple, isn't it? Then divide the total cost allocated to lots by the number of lots, and you get a cost per lot. What am I going to use that for? You get my cost of goods sold. If every time I sell one of the lot A's, my sales price presumably is going to be around $10,000. Debit cash or accounts receivable by 10 and credit sales by 10, don't you suppose? What's my cost of goods sold going to be? 4,000. Debit cost of goods sold and credit inventory by 4. By the way, when I bought the total cost was $1 million. When I spent the $1 million, it's credit cash or some sort of a payable by $1 million, right? Probably long-term debt of some kind, right? And debit what? Inventory. It's not land, it's inventory of lots. Everybody got the idea? Okay, so it's the inventory itself, it just happens to be land. So they say, well, what if you sold 77 lot of A on the top of page 483? 77 times 4,000 is 308. Take the sale of 770, which is, of course, 10,000 times 77. And the difference is their gross profit. Okay? And so on. So you're going to be estimating everything. Okay. Purchase commitments. This is really a funny one. Purchase commitments is an example where even though we haven't received the inventory, we can record a loss, or we will record a loss, because the inventory has declined in value. What do we usually do if we just have a purchase order outstanding? I placed a purchase order. You record a journal entry for placing a purchase order, or for a sales order. Custom order, something, a sales order, purchase orders, you buy something. Do we record an entry? No. We wait until what? To deliver the goods or services, right? You don't have inventory till you buy it. You don't mean I haven't bought it till it's delivered. What's the problem here with the purchase commitment? I'm committed to buy something in the future, right? Get it even next account. But I know that the price of what I bought has declined. So now I'm locked in to buy something for $1,000 a ton, right? Buying some sort of mineral for $1,000 a ton. Price has gone down to $900. What could I buy it for now? I could buy it for, well, I'm going to have to pay the $1,000, right? That's going to be my cost because I'm locked in. But what could I now if I bought it right now? The price has gone down to $900 in the market. $900. Do I have a real $100 loss? Yes. Now, we don't usually adjust for changes in market value unless it's available for sale securities or trading securities, right, guys? Because there's a market value, we write it down into the period. This is inventory we don't even have yet, but are we going to have a loss? Yes. If the price doesn't change at exactly the moment we buy it, because they're going to pay $1,000 for something that's only worth $900. Yeah. To be conservative, what do we want to do? Write it down at the end of the year. I want to get it written down in the year that I have the loss, not wait until later. So I know the loss is coming. I can estimate it. So this is a strange one. I don't like it. It's kind of cool. What do the journal entries look like on this purchase commitment?
Debit loss on purchase commitment?
Well, take a look on page 44. Yeah. Except what kind of a loss would it be? Unrealized. Why? I haven't bought it yet. I haven't sold anything yet. No cash changed hands, right? So it's an unrealized holding gain or loss. Got it? Okay. On purchase commitments. Okay. So unrealized loss on purchase commitments, and then I record an estimated liability on purchase commitments. Now, it's this thing of unrealized holding gain or loss. It can only be a gain to the extent of what, guys? To the extent I previously recorded a loss. You can't write it up to market if market is more than you're going to pay for it. Still got the lower cost or market rule in here. But you can recover it, right, if the price of the goods recovers by the time you take possession of it. Okay? So they show some examples of that. Take a look at that. And they, timber companies they use is a real common one. The price is fluctuating a lot. Again, this would apply to people that are buying and selling minerals, right? So where the market price is moving. So what they're going to do is they are going to record the loss. Look at that first journal entry. Debit the unrealized holding loss, really. This is a loss. Okay? Goes in the income statement on purchase commitments. $3 million in this case, because what happened was the price went down by $3 million. They negotiated a contract for $10 million, the price drops to $7 million, and they have to follow through with the 10. So they predict they're going to have a $3 million loss at the end of the year. Debit the loss, unrealized holding loss, and credit an estimated liability on purchase commitment. Strange liability, huh? Okay? So we've got that sitting there. Okay? Then what happens when the stuff comes in, when we buy it? The second journal entry on page 484. Debit purchases or inventory. What kind of accounting method are you using, inventory method are you using if you debit purchases? And what kind are you using if you debit inventory? Purchases is what? Periodic. Inventory is what? Perpetual. That's all that's happening. So yeah, one or two. $7 million. Credit cash for the 10 that you're going to give them, right? Or accounts payable if you're not giving them the cash right away, right? Either way. And then debit what? That estimated liability. Now, why'd they bother with this? I want to get the loss recorded in the year the loss happened. I'm taking possession of the inventory the following year. So I record that estimated liability on the purchase commitment, and then when I pay for the goods, I get rid of it. And I don't have a loss twice, right? I don't have a loss next period. What if the price goes up, though? In the third one there, what happens is the price goes back up.
Get rid of the loss and debit the liability to get rid of it.
You bet. So debit the liability to reduce it. You can see the estimated liability goes down, and you credit the unrealized holding gain or loss, right? So you might in one year have a recovery of the loss, or have a loss, and in the second year have a recovery of the loss. Make sense? So to increase your income the second year. You just make the best estimate you can at the end of the year. And you treat it like a change in estimate, right? How does a change in estimate get reflected in the financial statements? Remember that stuff from higher period adjustments, corrections of errors, change in estimate? Prior period adjustment is correction of error. Change in estimate is I made the best estimate I could, and now I'm making a different one. What is this? It's a change in estimate. How do you handle those? In the current year and into the future, right? Respectively to the future. You don't go back and restate the prior years, do you? Okay? Tell me what the journal entry would have been here if on the date that they delivered the goods, and I'm going to record the transaction, the value is now $8 million. So we didn't do the third entry there, but we did the first one. We didn't do the second one yet, okay? But we're going to have to pay for the inventory. What would it be? So you got the first one. We recorded the $3 million loss. And now I'm giving him $10 million in cash. I'll do the credit. Credit cash, $10 million. What do you debit? I said the inventory is now worth what, 8? Is that what I said?
Yeah, purchases for 8, and then debit the liability.
Purchases or inventory, whichever one, for $8 million.
And debit the liability for 2.
Only 2? This is that estimated liability, right? Estimated liability on purchase commitments. Okay. But how much do I have in there? And I received all the goods, so what am I going to have to do? Not just 2. It's got to be the whole 3. I need one more. What is it?
Gain, unrealized holding gain.
Yes, unrealized holding gain. So is that unrealized holding gain or loss? A lot of companies use the same account. They're doing this all the time, right? Sometimes it's a gain, sometimes it's a loss. Okay. So it's an unrealized holding gain. Got it. This isn't bad, is it? All I did was I combined the second journal entry and the third journal entry on page 484 into one. True, guys? Because ultimately that inventory was going to be worth $8 million worth. Okay? All right? It recovers. Okay? So, I guess we'll stop there. Gross profit's also an easy one. The way they do it is kind of strange. And then we get to retail inventory methods, which is really fun. Make sure you work bunch of exercises problems on retail inventory methods, including dollar value, retail dollar value, like Friday yet?
Really supportive. Really good class.
Yeah.
Reviews that bad.
Just adding a layer. Okay, and remember you said that. See if you got it right. Little brain. So anyway, the grades in your quizzes you're going to get.
Well, I'm gonna find mine.
Yeah, just drop them. That's good. Yeah.
I got it. Thank you.
Can't believe it. Well, actually, I can't. Did I get yours?
I'll have to find it in some USB stuff.
I know, so there's different, what did you say that the third one was? What happens here?
Well, what I'm saying is, this one is a recovery. You recovered before they paid for it. So if I've done this and it recovers the next period, I do this. And then when I pay for it, the loss. It went down to 7, now it's worth 8. So they put 1 back in. That's what this is. And what I'm saying is, well, what if you realize you don't realize it recovers until you actually pay for it, but it did recover? That's what you say.
You know what I was asking you. I wasn't really asking you if you wanted to get food. I was asking you if you wanted to go to Starbucks. I don't want to get all food. I still haven't heard back from you. That emailed me again.
How long has it been?
I apologize in advance, but tonight I'm going to be like a mad woman. That's fine.
I've got yours.
I think I'm going to look at
Email's different.
Yeah. So you told me to stop working, but GM hasn't emailed me.
Where you
Works
looking for
at
now?
I work at a gym on top of Under Armour.
You're just going to drop out of school?
Well, pretty much.
Well, you know what Krzyzewski said. Did you hear about it?
No.
He said lots of people, not just athletes, get opportunities. They're just too good. So they drop out of school to go work. That's probably what's happening with you, right? You're making so much money on these jobs that you're doing. There's no reason to get an education.
I hate him so much.
You know, if someone's going to give me $100 million, I'd probably disappear too. Yeah. So that's the deal you got?
Blair's so good. Well, no.
$1 million, maybe.
I'm not working that much at the gym, and they're paying to get my personal training and my group fitness